Hey everyone, and welcome. You've probably stared at a company's balance sheet, seen that section called Current Assets, and your eyes just kind of glazed over, right? Well, today we're going to decode that. We're going to figure out the story those numbers are trying to tell us. Okay, first things first, the most important rule. Current assets are basically anything a company thinks it can turn into cold hard cash within 1 year. That's it. This is the stuff that keeps the lights on, the fuel that powers the company day to day. So, here's our game plan. We'll kick things off with that basic 1-year rule, then we'll dive into the big stuff, inventory and debt. And yeah, we've even got a little financial mystery to solve along the way, before we get to the cash and wrap it all up. Right, so let's really hammer this home. The 1-year liquidity rule. Why a year? Well, think about it. That's the typical cycle for a business to figure out if it can pay its bills, right? Stuff like payroll, rent, paying suppliers. If those current assets look good, it's a pretty strong sign the company can handle its short-term cash needs, no sweat. Okay, let's dig into the first big piece of the puzzle you'll almost always find, inventory. Now, this is all the physical stuff the company plans to sell. But here's the secret. That single number you see on the balance sheet, that's just the headline. The real juicy details, the real story, is always buried in the notes. You see, inventory isn't just one big pile of stuff. It's more like a journey. It starts with the basics, the raw materials, the nuts and bolts. Then it moves into work in process, where things are actually being put together on the assembly line. And finally, you get the finished goods, the shiny new products sitting in a warehouse just waiting to be shipped out. But wait, there's one more step in this journey. In transit. This is actually pretty simple. You know when you order something online and you get that email that says your package has shipped? At that moment, it's yours, even though it's not at your door yet. It's the exact same idea for a company. They own that inventory, even if it's currently on a truck, a train, or a container ship in the middle of the ocean. All right, now we get to what I think is the most fascinating part of this whole thing. We see a massive number for money that's owed to the company, but it's listed as unsecured. That means no collateral. No safety net. If the customer just decides not to pay, there's nothing to take back. So what is going on here? So before we solve that mystery, let's just get the terminology straight. The official term is trade debts. All that really means is money that customers owe the company because they bought something on credit. Think of it as a big pile of IOUs from all their customers. And look, the difference here is absolutely crucial. With secured debt, if you don't pay your mortgage, the bank takes your house. Simple. But unsecured debt, that's based on nothing but trust, a handshake, a promise. For the person lending the money, it's a huge gamble. So that brings us right back to our puzzle. Why in the world would a huge company risk millions and millions of dollars selling stuff on credit with zero collateral? I mean, from the outside, it just looks like a crazy, reckless decision, doesn't it? And the answer, yep, you guessed it, is hiding in the notes. This is the perfect example of why you have to read them. It turns out the customer is the government, and the notes say there's no recent history of default. So just like that, what seemed like a giant red flag, a huge risk, is actually a sign of an incredibly strong and reliable partnership. The context changes everything. All right, let's keep moving. Our next category is a little weird at first glance. It's about money the company has already spent. Now, you're probably thinking, how can money I've already paid out be an asset? But it actually makes total sense when you realize they've paid for a service or a benefit they haven't received yet. So this bucket has a few different things in it. You've got loans and advances, which are usually small loans to employees. Then you have prepayments. This is like paying your rent for the whole year up front. You've paid the cash, but you still have the right to live there for 11 more months. That right is an asset. And finally, you see something called accrued return. This just means a company has earned a profit on an investment, but the money hasn't actually landed in their bank account yet. Okay, we're getting to the end of the line now, to the most liquid assets of all. This is the stuff that's basically cash, or can be turned into it at the snap of your fingers. Look, a smart company isn't just going to let its extra cash sit around in a checking account earning nothing. No way. They park it in super safe, short-term investments to make a little bit of interest. Things like government bills and bonds. Honestly, you can just think of this as the company's high-yield savings account. And finally, we have cash itself. The most simple, most straightforward asset there is. This is the money in the bank, ready to go, ready to be spent whenever it's needed. So let's pull back for a second. After looking at all these pieces, it's pretty clear that current assets isn't just some boring list of numbers. It's a story. It's a story about how the company runs day to day, who its most important customers are, and really how healthy it is in the short term. So what's the big takeaway here? How do you read this story for yourself? Well, first, remember that current assets are your number one clue to a company's short-term health. Second, and I can't say this enough, always read the notes. That's where the real action is. Third, remember that context is king. Unsecured doesn't automatically mean risky if the customer's rock solid. And finally, just remember that every single number is a piece of a much bigger story about the business. Once you learn how to read between the lines like this, a balance sheet stops being this scary, confusing document, and it becomes a roadmap that shows you exactly how a company operates. So I'll just leave you with this one question to think about. Now that you know what to look for, what story is your company's balance sheet telling you?